If you get this part wrong, everything you build on top of it could be at risk. Welcome to The Explainer. If you're a contractor in California, you know that building thins to last is the name of the game. Today, we're going to take the official CSLB guide on business management and turn it into a simple, step-by-step blueprint to help you build a much stronger business.
All right, let's get right into it. Just like any construction project, we've got 4 key stages. We're going to start with the foundation, that's your business structure. Then we'll move on to the framework of all that essential paperwork. After that, we'll do an inspection of your financials. And finally, we'll look at how to really fuel your company's growth.
Okay, first things first, you have to pour a solid foundation. I'm telling you, if you get this part wrong, everything you build on top of it could be at risk. This is about so much more than just picking a name. It's about protecting yourself, your family, and setting your company up for success in the long run.
So this is the first big decision you're going to make, and it really does affect everything from your personal liability to how you pay your taxes. Now, sure, you could be a sole proprietor or have a traditional partnership, but those often leave your personal assets totally exposed. For contractors, that's a huge risk. That's why the choice usually comes down to an LLC or an S-Corp, so let's really focus in on those two. Look, both an S-Corp and an LLC do the single most important thing. They build a wall between your business debts and your personal assets. That's absolutely crucial. The main difference is really in the details. An S-Corp can give you some nice tax advantages, helping you avoid what's known as double taxation. An LLC, on the other hand, usually gives you a bit more flexibility, but you'll need a really solid operating agreement to spell out exactly how the business is going to run.
All right, let's move on to the framework. With your business structure chosen, it is time to put up the framing. We're talking about the essential paperwork that makes your business official and keeps you on the right side of the law. I know, it might seem like a hassle, but it is absolutely critical to get this right.
Think of this as your 4-step checklist to getting your business totally legit. First up, you need a federal employer identification number, your EIN, from the IRS. That's for employee taxes. Second, you'll need a state-level EIN from California's EDD for state payroll taxes. Third, if you sell any materials, you'll need a seller's permit. And finally, and listen, this one trips up so many people, you have to check for local city and county permits before you start any job. Don't skip this step. Now for the inspection phase. This is where we learn to read the vital signs of your business's financial health. You see, your financial statements, they're not just for your accountant. They tell a story about what's working, what isn't, and where your company is really headed. A balance sheet might sound really complicated, but honestly, it's just a snapshot in time. Seriously, imagine taking a photo of your business's finances on one specific day. On one side of that photo, you've got everything the company owns. Those are your assets. On the other side, you've got everything it owes. Those are your liabilities. And here's the thing, it's called a balance sheet because they always have to balance out.
Let's just look at this example from the guide. This company has $250,000 in current assets. That's cash, money that's owed to them, things like that. Then they owe $180,000 in current liabilities, bills that are due soon. The key insight here is super simple. They have more cash coming in than going out in the short term. That is a very healthy sign. So, all of this brings us to a crucial point, understanding your working capital. It's simple, really. You just take your total current assets and subtract your total current liabilities. That number you're left with, that's your working capital. It's your cash cushion. It's the money that lets you pay your bills, make payroll, and jump on new opportunities without breaking a sweat.
So if we take the numbers from our sample balance sheet, that's $250,000 in current assets divided by $180,000 in current liabilities, we get this number, 1.39. So what? What does that number actually mean for the business?
Well, it means this company is in a pretty good spot. This number is called the current ratio, and it tells you that for every single dollar in bills you need to pay soon, you have $1.39 ready to cover it. It's a powerful, at-a-glance way to check your company's ability to stay afloat and handle its day-to-day debts. And finally, let's talk about expansion. Once your business is stable and your financials are looking good, of course you're going to want to grow. But growth costs money. You'll need the right kind of fuel to take on those bigger, more profitable projects. You know, capitalization isn't just about buying new trucks and tools. A huge part of it is having enough of that working capital to bridge the gap between when you have to pay your crew and your suppliers and when you actually get paid by the client. That timing difference is honestly one of the biggest challenges for growing contractors. And this quote from the CSLB manual, It is so critical. Clients will often hold back that final 10% payment, called retention, until long after the job is done. But here's the thing the manual points out: that 10% is often larger than your entire profit margin on the job. Just think about that. It means your profit, and maybe then some, is tied up, putting a huge strain on your working capital. So when you need funding to grow, you've really got two main choices. You can bring in investors who provide equity funds that give you cash in exchange for a piece of the company and a say in how it's run. Or you can take on debt funds. That's borrowing money that you have to pay back with interest, but you keep full control. Each has its pros and cons, and the right choice really just depends on your long-term goals. So let's recap our blueprint. 1, start with a solid legal foundation, like an LLC or S-Corp, to protect yourself. 2, frame your business with all the right paperwork, your tax IDs, your permits. 3, regularly inspect your financial health with tools like the current ratio. And 4, before you grow, you have to understand how things like retention are going to impact your working capital.
And that's our explainer on building a strong contracting business. Following these fundamental steps can be the difference between a business that's just struggling to get by and one that really thrives. So the question now is, with this blueprint in hand, what are you going to build?
Your business deserves a safe, strong foundation. Speak with a professional to get it right. Schedule a consultation with us today.